mechanics that drive the balance sheet and the income statement. So our first LOS asks us to explain and classify common asset accounts. Well, what is an asset? An asset is anything that will lead to a future flow of benefits, future inflows to the company. Now our first definition there is cash. Well, that's obviously cash that's held in your bank account, and cash equivalents. Cash equivalents tend to be short-term debt instruments with maturities of less than 90 days, so less than 3 months. So it could be short-term T-bills, certificates of deposit, that kind of stuff. Accounts receivable. Well, accounts receivable are going to arise due to the accruals process. We record sales at the time of the transaction, not when the cash flow is paid or received. What that means, therefore, is there will be sales in the income statement at the year end where we've yet to collect the cash from our customers. So we record an asset in the balance sheet indicating that our customers owe us that cash. And we could either call that accounts receivable maybe, or trade receivables, but it's amounts owed by our customers where we've sold goods but they've not paid at year end. Prepaid expenses. Now this is where we've paid for a good or service but not yet used it at the year end. And the argument is, if you've paid for something but not yet used it, the expense shouldn't go through the income statement. So instead we're going to record it as an asset in our balance sheet, indicating that we're entitled to use that good or service in a future period. Now our inventory really is made up of 3 elements. Our inventory is made up of raw materials, work in progress, and finished goods. Now, if you're just a trading company that buys in goods and sells them on, it will just be finished goods. So raw materials are our components that we're going to use in the production process. Work in progress reflects the items that we've started to construct but haven't finished at the year end, so partly completed finished goods if you like. And then finally, finished goods are goods that we've completed but not yet sold at the year end. Now we also see our plant, property and equipment. Sometimes we will refer to these as tangible fixed assets because they have tangible physical form. Our plant, property and equipment represents all of the assets that we're going to use for continuing use, or the tangible assets that we're going to use for continuing use within the business. So in things like, of course, land, it's things like building, it's things like equipment, etc. Our next classification down there is just investment property. That tends to be things like real estate held for investment purposes. So you might have bought, let's say, an apartment building, and you've got that apartment building and then you're renting it out to generate income. Well, it would be an investment property because you're holding it for investment purposes. Intangible assets, these are again going to be long-lived assets like our plant, property and equipment. The difference is here we have no tangible physical form, so you can't touch, feel or stroke them. So they're going to be things like goodwill arising on acquisitions, but things like patents, royalty agreements, etc. And we'll talk more about all of these things as we go through financial reporting and analysis. Financial assets, these are going to be investment securities, so debt and equity held in other companies. And again, there's going to be different classifications of them that we'll look at later. Investments held under the equity method. Now you don't need to really worry about what the equity method is at level 1, but we will be seeing it heavily at level 2. You need to be aware that this is how we account for associates. What is an associate? An associate company is one which you have influence on, but not outright control. And we do something called a one-line consolidation. One line appears in our balance sheet and one line appears in our income statement. So investments in our associates where we have influence but not control, we account for under the equity method. The other asset we've got here is a deferred tax asset. Now I don't want to get too much into deferred tax because we're going to see it later and it's going to cause us some headaches, I can tell you that right now. All you need to know briefly at the moment is a deferred tax asset arises because we pay more tax now, but we're going to pay less tax at a future date. Let's have a look at some of our liabilities. Accounts payable, otherwise known as trade payables. Well, this is the flip side of our accounts receivable. If we buy goods from our suppliers but have yet to pay for them at the year end, the purchase is going to go through our income statement, but we need to record the fact that we owe our suppliers these amounts, and we record them as accounts payable or trade payables. A liability, therefore, represents a future outflow of benefit from the company. Provisions. Let's talk about provisions. A provision is an estimated liability. Because of prudence, which is a kind of an accounting concept, it says we should provide for expenses as soon as they're foreseeable. So in other words, you might be being, let's say, sued at the year end, and there might be a chance that you're going to have to pay out. So we might create a provision and put the expense in the income statement and create a liability in the balance sheet. It's an estimated future liability, therefore. Other provisions you often see are restructuring provisions, where the company knows it's going to incur a cost restructuring a division, but it hasn't actually incurred that cost yet. Well, you still put the expense through the income statement and you create a liability in the balance sheet. So provisions are estimated expenses. The tax expense that you see in the income statement is a provision because you don't actually know the dollar amount of tax that you're going to pay at year end when you produce your final accounts. There's a whole toing and froing between the company and the tax authorities before they actually agree on what should be paid. Accrued liabilities. Well, accrued liabilities are essentially where we've used a good or service, but we've not yet been invoiced. So it's not showing up anywhere in the financial statements. Now, the accruals process says if you've used a good or service, we want the expense in our income statement. So we put the expense in our income statement, and we're going to put a counterbalancing liability indicating that we're going to have to pay for that expense in our balance sheet, and that is our accrued liability. Financial liabilities, these could essentially are any kind of short-term debt instruments that we might have, things like notes payable, they could be derivatives, etc. Current and deferred tax. Our current tax is the provision for what we believe that we owe the tax authorities based on this year's profits. Deferred tax liabilities are the flip side of deferred tax assets. Now, with a deferred tax asset, we said for some reason we've paid more tax now, but we'll pay less tax in the future. So a deferred tax liability is the other way around. For some reason we paid less tax now, but we're going to pay more tax in the future. Now, again, I don't want you to worry about it other than know it's a liability. We'll do deferred tax later. Unearned revenue. Now, unearned revenue is when our customer has paid us, but we've not yet met the criteria to record a sale in our income statement. Okay, so normally the earnings activity is yet to be completed. Now, in this scenario, we shouldn't be showing a sales. So when we receive the cash, our cash goes up, and we're also going to record a liability indicating that we owe our customer this good or service, and we call it unearned revenue. Debt payable, so these could be long-term bank loans, but they could also be bonds, so bonds that the company has issued. And a bond, of course, is nothing more than an IOU, a corporate IOU. The investors advance the cash to the company gives them a bond. On that bond, they will receive coupons until the end of the bond's life, and then they'll get par value back, $1,000. Okay, so those are our common liabilities. Let's turn our attention now to equity. We often refer to equity as a residual, because if we take our assets, subtract our liabilities, anything that's left over belongs to our stockholders. So what are we going to see? We're going to see capital at par value. What happens is the company must assign a par value to its stock. Typically it will be $1 in the US, but it doesn't have to be $1. So they're going to put their capital in at par value. So let's say our par value for our company is, I'm going to say, let's have a par value of $1. And let's say that we issue 100 shares for $150. Now, if you issued 100 shares, your capital at par value is going to record 100. But if we received $150, our cash has gone up by 150. If equity only goes up by 100, how's the accounts going to balance? Well, that's where additional paid-in capital comes. Any amounts over and above par when you issued shares goes into additional paid-in capital. Now, typically under international accounting standards, rather than calling it additional paid-in capital, often what you'll hear it being called is the share premium account. So essentially, capital at par plus additional capital represents the cash that the company has raised when it issued shares. Now, it's when the company issued shares. Subsequent fluctuations in market value of the shares are not reported in the financial statements. At the end of the day, they're not the company's problem, that's the shareholders' problem. Okay, so we often call this contributed capital in aggregate. So it's going to be the common stock, again, in Europe, you'd tend to refer to common stock as ordinary shares, but it's exactly the same thing. The voting shares, it would be the preferred stock or preference shares as well, non-voting shares that receive a fixed dividend. Our retained earnings, of course, are the key linkage between our income statement and our balance sheet. Every year, essentially, the retained earnings are going to change by, well, how much do they change by? That year's net income minus that year's dividend that is paid or proposed. So in other words, retained earnings increase each year by reinvested earnings. So it's just the cumulative amount of reinvested earnings since the company was set up. And actually you can use your retained earnings to pay out dividends even if you're loss making. They're called uncovered dividends in that scenario. We're also going to have our other comprehensive income items. Now our other comprehensive income items are any gains and losses that were generated that did not go via the income statement. And we're going to see a little list of them later, so I'm not going to go through them now. But they result from maybe unrealized gains and losses on investments, for example. It might be due to pension accounting. It might be due to how you convert your overseas subsidiary. So these are strange gains and losses that have not gone via the income statement and yet still represent gains and losses to the shareholders. We'll talk more about those later on. Now, here's a change. Non-controlling minority interests. Now, this is only going to see minority interests in group accounts. Now, the idea is if you acquire a subsidiary, and that's when essentially you have control over another company, you have to consolidate it, which means you take the parent company's assets and liabilities and you bring in the subsidiary's assets and liabilities. Now you bring in 100% of that subsidiary's assets and liabilities regardless of whether you own 100% of shares or less. So let's imagine the scenario where we only own 80% of the share capital in a subsidiary. We still bring in 100% of its assets and liabilities into our group balance sheet. And the reason behind that is group balance sheets represent what you control, not what you own. Now that means we brought in essentially assets and liabilities that didn't belong to us. Now assets minus liabilities equals net assets. So we brought in net assets that did not belong to us but belong to other shareholders. So in our stockholders' equity we're going to have what we often refer to as a non-controlling or minority interest. And it just represents the minority share of net assets in this subsidiary. So if the minority owned 20% of the subsidiary, we'd include 20% of the minorities, 20% of the subsidiary's net assets. Okay, now, minority or non-controlling interests under US GAAP used to be treated as mezzanine finance, which means essentially they were after debt but before you got to equity. 2010, this changed as a part of harmonization with international accounting standards. Minority interests are now included within stockholders' equity under both international accounting standards, but now also US GAAP. Now there is one extra one I just want to add on to this that I think you should have an awareness, and that is treasury stock. Now treasury stock is going to reduce stockholders' equity. Treasury stock represents shares that the company has purchased in itself. So it's bought back shares, so therefore it's going to reduce stockholders' equity. Essentially most elements of stockholders' equity are credit balances. This would be a debit balance. Okay, I don't want you to worry too much about credits and debits. So treasury stock simply reduces stockholders' equity. It represents shares in the company that the company has bought back in the marketplace. They sit there as treasury stock. The company can then reissue those shares at a later date. Now let's turn our attention to the income statements. Here's some key income statement items. Our first thing is sales. So these are sales of our core trading activities. In other words, sales of products and services. Now sometimes you don't see them written as sales, sometimes you see it written as turnover. So just be aware, turnover and sales, same thing. We might also see other sources of revenue such as gains in our financial statements. Gains when we dispose of things like our long-lived assets, if you dispose of some plant, property and equipment, if you dispose of some intangibles, for example, or some investments, you might show gains. Of course, if you essentially sell it above its balance sheet value, you're going to show a gain. If you sell an asset below its balance sheet value, you're going to show a loss. So the flip side of our gains up here is down here with losses. So it tends to be disposals of our long-lived assets, both intangible, PP&E and investments. Now, of course, we might also receive investment income. So this essentially is going to be dividends and capital gains and losses. So if we hold shares in other companies, then we're going to receive dividends on them. Now, of course, if we hold debt in other companies, we're going to receive interest. We might also make capital gains when we actually dispose of them. Now we're also going to see that certain type of investments, unrealized gains and losses, so changes in market value prior to the disposal also go through the income statement, but only for certain investments. And I don't want you to worry too heavily about that right now. We'll define those a little bit later. Okay, so those are our sources of revenues. Let's have a look at our expenses. Revenues, of course, increase your net income. Expenses are going to reduce your net income. Your costs of goods sold. These are any costs incurred in producing the goods and services that you sell. So if you're a manufacturing company, it's going to be labor, it's going to be production overheads, it's going to be materials, etc., etc. So the cost of goods sold, any cost in manufacturing and completing essentially the goods for sale. Now, once your good is finished, any additional costs do not go through cost of goods sold. So let's have a look at sales, general and admin, SG&A. Sales, general and admin essentially includes any costs involved in selling a product, any general and administration costs. So these are any costs that the company incurs in its day-to-day operations, but which don't directly relate to the production of goods. So it could be the rent and rates on your head office, for example, that kind of thing. Directors' salaries could be treated in sales, general and admin. The auditor's fees, legal fees, all would go through sales, general and admin. Now, you should be aware that under both US and GAAP and international accounting standards, you do not need to split cost of goods sold and sales, general admin out on the face of your face of your income statement. Okay, but if you don't split them on the face of the income statement, you will have to show the split in your footnotes. Now, as well, we might see depreciation and amortization. Now, we're going to talk about depreciation and amortization a little later on, so I don't want to get into a huge amount of detail, but it's to do with our plant, property and equipment and our intangibles. The idea that we're releasing costs over time, and the cost that we release from the balance sheet for PP&E is depreciation. The cost we release from the balance sheet for intangibles is known as amortization. Now, you might find depreciation and amortization go through either cost of goods sold or sales, general and admin. If it's depreciation of plant, property and equipment that you use in the production process, it would go through cost of goods sold. If it's depreciation on things like directors' cars that aren't used in the production process, you'd expect it to go through sales, general and admin. Interest, what does interest represent? Interest represents essentially the cost of financing our debt. So it's going to be made up of coupons that we pay to debt holders, interest payments to debt holders, but we're also going to see it's a little bit more complicated than that later on. We've then got our tax expense, and again our tax expense is going to be more complicated than just what we owe the tax authorities based on this year's taxable income. We're going to see tax expense is made up of three elements. It's made up of taxable income, tax charged on taxable income, tax payable as we call it, but it's also made up of changes in deferred tax assets and deferred tax liabilities. Again, don't worry about that now. We are going to come and talk about that a little later. So our next LOS says explain the accounting equations. Now these are going to be critical. If you understand these, everything else that you do in financial reporting and analysis is going to be a lot easier. Now, first one we can see there is the income statement relationship. Revenues minus expenses equals net income. Fairly straightforward. But then we've got some balance sheet equations, and these are going to be critical. Now, because of double entry bookkeeping, assets equals liabilities plus owner's equity. So if assets increase, either liabilities or stockholders' equity would have to increase. Okay? And that's as a result of double entry bookkeeping. Now, double entry bookkeeping, if you want a boring fact that might be useful in some kind of quiz at some point in the future, double entry bookkeeping, but bookkeeping is the only word in the English language with three double letters in a row. Double O, double K, double E. Fantastic. Okay, so look, balance sheet equation. By definition, it always must balance. That's why we call them balance sheets. Assets will always equal liabilities plus owner's equity. So in other words, if a transaction affects one of these areas, either assets, liabilities or equity, there must be a counterbalancing transaction elsewhere to keep that balance sheet relationship working. And we're going to talk about that process in a little while and give you some examples of transactions. Now, of course, if assets equal liabilities plus owner's equity, if we were to subtract liabilities from both sides, we get assets minus liabilities equals owner's equity. Now, assets minus liabilities we often refer to as net assets. Now, net assets tends to be a European phrase. You tend to often refer to it as net worth in America. So just be a little bit aware in the exam they may be used interchangeably. They talk about net assets, they talk about net worth, they mean the same thing. So assets minus liabilities equals stockholders' equity. We mentioned before, take your assets, pay off your liabilities, anything that remains belongs to your stockholders. Now, owner's equity equals contributed capital and retained earnings. We saw this earlier. Contributed capital are the amounts paid by shareholders to acquire shares, split between par value and additional paid-in capital. Retained earnings, remember, are the key linkage between the income statement and the balance sheet. Anything, by definition, that affects the income statement will affect retained earnings in the balance sheet. Why? Because we take net income at the end of the year, we pay out a dividend, anything that is not distributed gets transferred to retained earnings. So retained earnings increases each year by the earnings that haven't been distributed by way of a dividend. So anything that affects the income statement, therefore, will affect owner's equity. Now again, this is showing that key linkage between the income statement and the balance sheet in a little bit more detail. So notice there's our beginning retained earnings, and that's just going to be from last year's balance sheet. And here is ending retained earnings, which of course is going to be this year's balance sheet. And all we're doing is reconciling between them. And we're saying, look, retained earnings will go up by this year's profits, net income. Obviously, if we've made a loss this year, it will go down. But it will go down by this year's dividends. So the change in retained earnings from year to year is net income minus dividends, the reinvested earnings that the company is reinvesting rather than paying out by way of a dividend. As a result, if the company doesn't pay a dividend, by definition, retained earnings would just change by that year's net income. Now, our next LOS asks us to explain the process of recording transactions. Now, again, this is very, very critical stuff. If you get the idea of how we have counterbalancing transactions here and that assets and liabilities always equal stockholders' equity, it's going to make the rest of what you do in financial reporting and analysis so much easier. So let's imagine, essentially, we pay a bill, okay? So we pay a bill. Let's imagine we pay a bill that's $100. So I'm going to pay a $100 bill. Now, what are the two sources? When I pay a $100 bill, of course, cash goes down by $100. So I'm going to decrease cash, which is an asset. The other side is I'm going to decrease the liability. Let's say they're saying we're actually paying off what we owe to our suppliers here. They've called it trade payables. Remember, it's also called accounts payable. So down would go accounts payable. So down goes assets, but down goes liabilities. So overall, our equity would remain static. Now let's imagine we now issue a bond. So let's have a look at that. Let's say we issued $2 million worth of bonds. So we're going to issue $2 million worth of bonds. So up goes our cash, which is an asset, by $2 million. The other side is we're going to record a liability, a long-term liability, because of course we owe these amounts eventually back to our debt holders. So up goes cash and up goes liabilities. Stockholders' equity would be unaffected by this transaction. It all still balances. Assets go up by $2 million, liabilities go up by $2 million, so net assets and hence stockholders' equity remain unchanged. Let's have a look. We're going to make a credit sale here. Let's make up an example again. Let's say we sell $150 worth of inventory and we sell it for, the sales price is, let's say, $200. Now, what's going to happen? We've got two sides to this. We've got the sale and also we've got the removal of inventory. So what we're going to do, essentially, and I think it's going to be easiest just to blank a little bit of text out here so we can fit this in. Let me just do that. Let's blank this out. Oh, I don't want it to be red. That's going to be confusing. Come on, change to white. Okay, there we go. So I'm just going to blank it out very briefly. Now, Let's deal with the sale of 200. What we're going to do here with the sale price of 200 is we're going to increase our accounts receivable, trade receivables, because our customer owes us now $200, so we're making an assumption that it's a credit sale here. And of course, the other side is in the income statement, we're going to increase sales by $200. Now also we've got the inventory. If we've sold the inventory, it's no longer in our balance sheet, so we need to reduce it. So we're going to need to reduce inventory. Now of course inventory is also an asset, and we're going to reduce that by 150. The other side of that transaction appears in the income statement in our cost of goods sold, which is an expense, 150. So notice we've now got net income of 50, and we've got overall an increase in assets of net increase in assets of 50 as well. So how is this reported? Our assets are going to go up by a net amount of 50. Liabilities are unaffected. So actually what's going to happen, because net income is $50 higher, retained earnings are $50 higher, and as a result your stockholders' equity would go up by 50. So notice now net assets have increased by $50, stockholders' equity is increased by $50. So as you can see in the balance sheet, inventory goes down, accounts receivable goes up, and we saw the net of that was $50 increase, and we saw that equity went up by $50 in retained earnings. And of course, that was as a result of more earnings in the income statement. Sales went up by 200, cost of goods sold went up by 50, and as a result, net income and hence retained earnings in the balance sheet increased by $50. Let's have some purchases of materials on credit. Let's say we buy $500 of materials on credit. Okay, if we buy $500 of materials, up goes our inventory by $500, which of course is an asset. But if we bought them on credit, we've not yet paid for them, so up goes our accounts payable by $500. So notice both assets and liabilities would go up by $500. Stockholders' equity would be constant. Let's have a look. We issue some equity. Let's say we issue $5 million worth of equity. What's going to happen here? Well, of course, if we issue $5 million of equity, we get $5 million of cash. So up goes cash by $500 million, which is an asset, so our assets increase. The other side, of course, is we need to increase our contributed capital. And of course, we would split it between common stock and additional paid-in capital. But up goes our equity, contributed capital, by $5 million as well. So up goes equity, up goes assets. Notice this time, liabilities are constant and unaffected. So equity's gone up, net assets has gone up. We incur an expense, which means we need our expense to go through the income statement. We've incurred an expense, but we haven't paid an expense here. Let's imagine it's our rent. So our rent is essentially due, and let's say we're paying $500,000 for our rent. Okay, now, of course, because we've occupied our premises, we want $500,000 to go through the income statement in our sales, general, and admin. Let's say, so increase sales, general, and admin, which is in the income statement. Now, if we increase sales, general, and admin, we've got more expense. If we've got more expense, then, of course, our net income would be lower by $500,000. The other side, because we've yet to pay, we need to record this as a liability. So we're going to increase a liability, indicating that we owe our landlord, presumably, $500,000. So notice what's happening here. Liabilities are going up. Equity is going down by the same amount. Assets are unaffected. Now let's say we then come to pay off our rent. So we come to actually pay our landlord. So this time we're actually going to pay our $500,000. So number one, if we pay our $500,000, we no longer need that liability we created. So down comes the liability, the rent owed to our landlord by $500,000. The other side, of course, decrease in our cash. So essentially liability down, asset down, equity unchanged. Okay, so hopefully you're getting the flavour that every time we have a transaction, it has two impacts on the balance sheet. Even if one side of the transaction affects the income statement, it's still going to affect the balance sheet. Anything that affects the income statement changes our net income, and if we change our net income, we affect our retained earnings. So everything is going to affect, anything that hits the income statement will affect the balance sheet via stockholders' equity. Let's push on. Let's look at declaring a dividend and paying a dividend. Right, okay, if we declare a dividend, so we're going to have a liability. Let's say we declare a dividend of 100,000, let's say. Let's make it up, 100,000. So we've declared it but not yet paid it. So therefore, dividends payable increases, which is a liability. So up goes dividends payable, indicating that we haven't yet paid that dividend to our shareholders. The other side is, of course, remember dividends, remember that linkage that we talked about with retained earnings. Take this year's net income, subtract any dividend paid, and that gives you the change in retained earnings. So as a result, our retained earnings are going to fall by 100,000 as well. So what we've got here is an increase in liabilities, reducing net assets, and a deduction in equity, keeping it all balancing. Finally, we then get to pay our dividend of 100,000. So we're going to pay out to our shareholders. So out goes our 100,000, decrease our cash by 100,000, of course, and also we need to reduce our dividend payable liability because we no longer own it. So down comes the liability and down comes cash. Stockholders' equity, therefore, is unaffected. Okay, so our next LOS, you'll be pleased to know, says explain the need for accruals and valuation adjustments. Well, of course, the idea behind accruals is we don't use cash accounting. Cash accounting would just mean you record any transaction when you pay or receive the cash. Well, that's not how the balance sheet and the income statement are constructed. Instead, we use the accruals method. The accruals method means we record revenues when they are earned, and with expenses, we attempt to match the expense against the revenue. Okay, now if the expense doesn't relate to the revenue, we then match the expense to the period of use. Now, the purpose or the idea behind accruals is it does lead to a lot more subjectivity and assumptions. We like it as an analyst because we believe, therefore, that the balance sheet and the income statement show the economic substance of the company and they give us information on future earnings potential. But the downside is there's more subjectivity. So let's just have a look at some of these accruals and valuation adjustments that we often tend to make these at year end. So bad and doubtful debts. You know some of your accounts receivable won't be collected. Some customers will default and not pay you. So what you need to do at year end is estimate how much won't be collected and reduce your accounts receivable. So essentially the bad debt provision nets against the accounts receivable, and it means the accounts receivable on the face of the balance sheet would decline. The other side of this bad and doubtful debt provision is it appears in the income statement. Prepaid expenses. As we mentioned, when we prepay an expense, we don't want the expense to go through the income statement because we've yet to essentially use the good or service. So down goes our cash and up goes our prepayments, which is an asset. Unbilled or accrued revenue. Unbilled revenue is where you've completed the earnings process, but you've not yet invoiced your customer. Now, if you've not yet invoiced your customer, the sale doesn't appear anywhere in the set of accounts. So at year end, we now need to record that sale. So we're going to put a sale in the income statement and we're going to record an asset because our customer is yet to pay us in the balance sheet. Okay. Why is it not accounts receivable? Well, because you'd create accounts receivable when you actually invoice your customer, and we haven't invoiced them yet. So essentially we call it unbilled or accrued revenue. Impairments and write-downs. Now these are going to be critical and we'll be talking a lot more about them later on. These are very, very subjective. Now an impairment, we tend to have an impairment if the balance sheet carrying value, and whenever we use the phrase carrying value, we just mean the amount recorded in the balance sheet. So if the fair value of an asset falls below its carrying value, you have an impairment. And you have to reduce the value of the asset in the balance sheet. The other side of an impairment appears as a big loss in the income statement. Very similar for inventory, but rather than calling inventory an impairment, we call it a write-down. So inventory sits in our balance sheet at cost, what we paid for it or what we paid to what it cost us to manufacture. It sits there at cost unless its realizable value, i.e. what we can get when we sell it, falls below cost. And if what we can get when we sell it falls below cost, we've got to write down. We have to reduce essentially the inventory down to its realizable value in the balance sheet. The other side appears as a write-down as an expense in the income statement. Now, certain of our investments that we hold, our passive investments, are marked to market. There are three classifications for passive investments: held to maturity, available for sale, and trading. Now, we'll talk about them in more detail later. But you should be aware, in the balance sheet, we mark certain ones, the available for sale and the trading securities, to market. So in other words, if the market value has gone up, you need to increase the balance sheet value of the asset. So you do that for the balance sheet, under available for sale and trading securities. Now, the other side of the double entry differs depending on whether you treat it as an available for sale or trading. The unrealized gain or loss as a result of your mark to market under available for sale securities goes directly to stockholders' equity. Directly to stockholders' equity, not via the income statement. Don't collect $200. I think that's what it is in Monopoly, isn't it? So any unrealized gain or loss on available for sale will go directly to stockholders' equity, one of those strange comprehensive income statement items we mentioned earlier. Any unrealized gain or loss on trading securities as a result of their fluctuation in market value gets taken to the income statement. But more on that later. So at year end, we're going to have to market certain of our passive investments. Accrued expenses. If we know we've incurred an expense, but we've not yet received the invoice, we still want the expense in our income statement, and we're going to record a liability in our balance sheet. Now, your classic example of an accrued expense, let's imagine your telephone bill. Now, of course, with your telephone, let's say your cell phone, you make your calls all throughout the month, but you don't receive the invoice from your phone company until after the month. Now, if the company knows it's incurred those expenses, it's going to have to put that expense in its income statement and create an accrual in its balance sheet, which is a liability. So, for any expense which you know you've incurred, but you've not yet received the invoice, you're going to create an accrual in the balance sheet, and you put an expense in the income statement. Deferred or unearned revenue. This is simply when the customer pays us, but we've not yet completed the earnings process. In order to record a sale, you need to have completed the earning process and have reasonable assurance that the customer will pay you. If we've not yet completed the earnings process, we can't record the sale. So up goes our cash, and rather than increasing a sale, instead we'll increase a liability called unearned revenue, indicating that essentially we've not yet completed the earnings process. Once we do finish the earnings process, we eliminate the unearned revenue liability and put it into the income statement as a sale. And then finally at year end, we also need to include any provisions. So if there are any uncertainties regarding expenses, we're going to put those through the income statement and we're going to put them in as a liability in our balance sheet. So it could be things like restructuring, it could be things like legal suits, lawsuits, that kind of stuff. Okay, our next LOS says explain the relationships amongst the financial statements. Now, hopefully we've seen a little bit of this already when we were looking at how our double entry, if you like, and the balance sheet equation meant that every time we affected assets or liabilities, we also affected stockholders' equity. It always was in balance. So if you remember, by definition, anything that increases or decreases net income in the income statement will affect the balance sheet. And it will affect the balance sheet, of course, via retained earnings. So net income hits the statement of changes in owner's equity. We take the net income for the year, subtract the dividend. That gives us the change in retained earning. Okay, so essentially we're seeing net income in the income statement. It's going here where we do net income minus dividend, which is the change in retained earnings, and therefore the change in retained earnings then goes to the balance sheet and is added to our retained earnings line. Okay. There are other linkages between the balance sheet and the income statement. In the balance sheet, we have our plant, property and equipment and our intangibles. And already we've said that we're going to depreciate or amortize them. And every time we depreciate them, essentially, you're going to reduce the value of the asset in the balance sheet. The other side is we put a depreciation expense through the income statement that reduces our earnings. Okay, what about the link between the income statement and the cash flow statement? Well, of course, net income isn't necessarily the same as cash generated. So what we're going to do is take our net income, strip out all of the non-cash elements to get something that we're going to refer to as cash flow from operations. So we're going to see that a little bit later. Essentially, it's net income, add back any non-cash charges, anything that's gone through the income statement that isn't cash, i.e. things like depreciation and amortization, and then essentially we'll subtract any increase in what we call non-cash working capital. Okay, so that any change in working capital, and I'll put non-cash next to it. Now again, I don't want you to worry about that just yet. We're going to do cash flow statements, and we'll talk about that more a little bit later. But of course, the total cash flow statement, we have three classifications, CFO, CFI, and CFF. Don't worry about those just yet. But the cash flow statement shows us the change in cash. So when we go to the balance sheet, of course, we should be able to confirm that by looking at this year's cash balance and comparing it to last year's cash balance. Okay. So there is linkages, in other words, between all those financial statements, and as we go through financial reporting and analysis, those linkages should be becoming more and more second nature to you. So hopefully this will come as we go through. So our next LOS asks us the accounting system flow. So first of all, every time the company has a transaction, it puts them through its journal book, a book of journals. This just includes every debit and every, that should be DR, every debit and every credit. All the debits and credits for every transaction. So we invoice a customer. We go credit sales, debit accounts receivable. We buy some goods. We go debit purchases, credit accounts payable. So all of the day-to-day double entry bookkeeping goes through the journal entries. It's just a huge list of debit and credit entries. Now again, you don't need to worry about debits and credits for the exam. Now, once we've got all of the double entry going through these journal entries, at the end of the year, what we're going to do is extract all of the entries and produce T accounts. Every item in the balance sheet, every item in the income statement is going to have its own T account. Let's just imagine one. Let me just make one up for you. Let's imagine it's our accounts receivable. So I'm going to draw you a T account here. So you can see why they're called T accounts, because they look like a T. So this is our accounts receivable T account. Now, of course, what you'll have in it is the amount of accounts receivable brought forward from the previous year, which will be last year's balance sheet figure. So let's say we've got $100 owed to us. Now, what would increase that amount? We then go back to our journal entries and we pick out all of the credit sales. So every time we've sold goods on credit, we'll sum those all from the journal entries and put them in. Let's say we've sold $2,000 worth of goods on credit. We'll also look at the journal entries to see if anything else that affects accounts receivable. And in particular, it's likely to be the cash that we receive from our suppliers. So let's say that we've got 1,800 of cash collected from suppliers. Sorry, cash collected from suppliers? Cash collected from customers. Now what you do then is you total off your T accounts at the end of the year, 2,100, 2,100. They both sides have to be the same. Now you'll say to yourself, hang on a second, that right-hand side has only got 1,800. So the balancing figure, if you like, it's just a plug figure. Our balancing figure will be 300, and this will be the carry forward figure. And the carried forward figure is just going to go to this year's trial balance. So we extract them and take them to the trial balance. Whoops, can I fit it in? Just about. So we have a T account essentially for every single item in the balance sheet and the income statement. And all we're doing is using the T account to summarize all of the debits and credits coming from those journal entries. Why? In order to get a carried forward figure that we're going to take to a trial balance. So let's talk about our trial balance now. So our trial balance, once we've got those carried forward figures from our T accounts, all it is just a list of all of those carried forward figures. Assets, liabilities, revenues and expenses. Now again, it's called a trial balance because the total amount of debit balances will equal the total amount of credit balances, unless our double entry bookkeeping's gone wrong, of course. So in other words, the amount of credits should equal the amount of debits, which is why we call it a trial balance. But so far, we've only picked up on the double entry that has gone through the journal entries. Now, there are certain things that won't go through the journal entries called our year-end adjustments. So we're then going to make our journal adjustments. So, for example, what type of things do we have on our journal adjustments? We might want to depreciate the depreciation of our PP&E, for example. We might have impairments that we need to record. Oop, impairments, spell it right. We might have write-downs of inventory. We might need to record provisions, estimated expenses, restructurings, etc. like that, if we haven't incurred the cash yet. So essentially all we do is we make these year-end adjustments. Oh, another year-end adjustment, there are more than this, but I just want to give you a flavour. The other year-end adjustment that we just talked about essentially would be the unrealised gains on mark-to-marketing of our trade securities and are available for sale. So essentially, let's call that mark-to-market adjustments. So essentially these journal adjustments are just debits and credits. Again, the total of the debits will equal the total of the credits so that the balance sheet equation still holds. So we make all of our year-end adjustments as a result of the accruals process. Other things will be bad debt provisions. We know some of our accounts receivable won't be collected, so we reduce the accounts receivable. So there are far more year-end adjustments than we make than I've put out here, but I just wanted to give you a flavour of what kind of things are happening. So once we put our journal adjustments through, we extract another trial balance, and we refer to that as the adjusted trial balance. So again, all it is a list of all of the debits and credits. It's a list of all of the asset balances, all of the liability balances, all of the revenue balances, all of the expense balances. And from this trial balance, we produce our income statement and our balance sheet. So that's what we use to produce the final financial statements. So that's how the flow of information flows through a firm and it is used to produce a set of financial statements. Almost there with this reading. Last real LOS says explain the use of results, i.e. financial statements, in security analysis. Now, of course, all we're simply saying here is be very careful. We can't just take the balance sheet and income statement and use it for security analysis. Why? Because there are loads of estimates and judgments going through because of the accruals process. And as a result, the analyst needs to make sure that they believe that those estimates and judgments are fair. Okay. Now, of course, the analyst doesn't just look at the balance sheet, income statement, cash flow statement. And they've also got to look at the management discussion and analysis to see, do the financial statements stack up with what the directors are telling you in the management discussion and analysis? And also, of course, within MD&A, if they've changed their accounting policies, which would reduce our comparability year on year, they should be disclosed. The big place, though, and it's absolutely critical for our analysts to look, is the footnotes. Because normally in the second footnote to the financial statement, we're going to see the accounting policies notes. It takes all of the major items in the income statement and balance sheet, and it tells us exactly what accounting policy the company has used in order to prepare its balance sheet and income statement. So, in other words, if you're going to compare between two firms, you need to compare like with like. If two similar firms have chosen different accounting policies, they are not directly comparable, and you would need to adjust the financial statements of one company to bring it in line with the other. The only way you're going to pick up that they're using different accounting policies is if you review the footnotes. So what we're simply saying, therefore, is we need to review, as an analyst, all of the estimates and judgments at year end. We need to also review any changes to the accounting policy for the firm year to year, and also, if we're comparing between firms, differences in accounting policies between those two firms. Now, just because the accounts balance, just because our extended trial balances, just means our debits, total of our debits equal total of our credits. It doesn't mean, of course, that the accounts are correct. You can fictitiously make up a sale, for example. As long as I go credit sale in the income statement, debit something else elsewhere, the balance sheet is still going to balance. The income statement will still agree. Okay, so all it means, essentially, it's an idea that we've got our total debits equal our total credits. It's an indication that the bookkeeping hasn't gone awry, but it doesn't mean it's correct. So just be a little bit aware of that. The key for the analyst is they want to see the true picture of company performance. And we'll keep coming back to this phrase. What they want to see is economic substance. I can't write today. Economic substance. So you've got to review the estimates and judgments, the critical accounting policies, and ask, do you believe that that shows you the economic substance of the company? If you don't, then you're going to have to make adjustments before you calculate your ratios. Okay, let's have a quick look at a financial reporting problem. So, which of the following would most likely change our stockholders' equity? Collecting our accounts receivables. Well, let's think about the double entry there. If we collect accounts receivable, up goes cash, down goes accounts receivable, which are both assets. So up goes an asset, down goes an asset. Nothing happens. So that's not going to change equity or liabilities. Let's imagine as well, let's skip C, declaring a dividend. We've seen this already. Increase a liability, dividends payable. And the other side of declaring a dividend would typically be reducing retained earnings. Selling a 5-year-old machine. Possibly it could change equity, because remember, the change in equity, what the accountants do at the time of disposal is they look at the proceeds they receive from the disposal of some plant, property and equipment. They then compare it to the balance sheet carrying value of that asset at the time of disposal, and any difference gives you essentially the accounting gain or loss that goes through the income statement. So if the proceeds are greater than the balance sheet carrying value at the moment of disposal, you get a gain. If the proceeds are lower, you get a loss. Now, of course, theoretically, if the proceeds equaled the balance sheet carrying value, there would be no gain or loss. Nothing would go through the income statement, so retained earnings would be unaffected. So I'm going to go for, therefore, C, because that always will have an impact. I think that is a little bit cheeky, because B, chances are, if the proceeds differ from the balance sheet value at disposal, that would also affect gains and losses in the income statement, and as a result, retained earnings. Okay, but we know declaring a dividend will always. So a little bit tricky, nasty question, that one.